And this is how to tax corporations. So before I go on, it's really important to talk about how corporations make their money, okay? So corporations make their money in a variety of ways. The first and most obvious way is they sell a product, right? So if you think of a local company, they sell products to consumers, you pay money for those products, and then they make a profit because they pay their workers less than the benefit that the workers are giving the employer, and that's how profit is made, and that's how, right? So, okay. The second way is through investments. So companies, like regular people, can use the stock market, right? They can use their money to buy shares. Oftentimes, when a company is buying shares, they're doing it for an ownership position. They see a profitable enterprise, and they want to get in on that, so they purchase shares of it and either receive dividends or use it to do a hostile takeover. Quick aside, a hostile takeover of a company is where the ownership is forcibly replaced by its voters, but its voters have been co-opted either by a large corporation or because all the voters are now the large corporation. So that's what a hostile takeover is. It's a type of merger and it's a type of acquisition scheme that corporations use. But anyway, so the point is corporations can also make money through investments. And another way that companies make money is by offshoring. So what offshoring is essentially the company sees that it has to expend a certain amount of money each year to do its business, whether that's creating widgets or selling services or whatever it is, and they take a look at their costs, whether their costs are labor, capital, which is workers, whether it's land capital, which is like buildings and assets, whether it's entrepreneur capital, which is like typically the C-levels or founding members. So typically they're looking at those three, and they're trying to decide whether fourth capital, money, how they can maximize that level of capital. So during the pandemic, one of the ways that we've seen that companies have done cost saving is they've closed up their offices and sent their workers home. Now, not all companies can do this, of course, especially if you're in manufacturing or you're in fast food or you're in a situation where you are unable to have your employees work from home. But in the event that they can work from home, that's a cost saving that they can have as well, right? But the other and more traditional offshoring is to say, I have a job that I pay X number of dollars in country A, and in country B, I can pay Y dollars, where Y dollars is fewer than X dollars, right? So they make a decision, which is to say they move the job from country A to country B in order to pay less money. And this is a standard cost saving money. And this is a way that companies make money as well. So that's how corporations make money. When it comes to goods and services, that is a large category, and that breaks down even further. So companies can use a couple of different methods in the sale of goods and services to make money. So one is just standard, it costs me $5 to make this item. I sell it for $7, I get $2 profit, right? There's another more complicated scheme where I have, let me just turn that off, where I have two products, product A and product B. Product A cost me $5 to make, and product B cost me $1 to make. So if you then sell both products for $5, you break even on product A because it costs you $5 to make it, and you make $4 profit on product B because product B only costs you $1 to make. So at the end of the day, where you could have said product A is $7 and product B is $3 and still made the $4 profit, you were able to keep both products the same, which of course has psychological benefits and is likely to make your customers, it depends on which one you can sell. In the restaurant industry, one of the ways that this is done is with coffee and pizza. Coffee, pizza, and other cheap goods are typically overpriced, so that items that are very expensive for the restaurant to make can be lower priced. So they either lose money on some to make high profits on others, or they break even on some to make high profits on others. But anyway, so this is a different way to do a different scheme for making money. The same thing is true with services. If one service costs a lot of money to do, but it can be bundled with a service that doesn't cost much money to do, and they can make a profit off of that. They can lose money on one service while making lots of money on another service. So you get the general idea. So in order for, and by the way, one thing you have to keep in mind whenever you tax corporations is that any time that the corporation can pass the cost of the tax onto the consumer, that's what they're going to do. Just as a matter of course, it's one of the ways that companies save money. Now, luckily, companies can typically spread out the costs of that evenly. So oftentimes consumers only notice a very marginal, a very small increase in prices. This is true about raising wages as well. So, even if someone is being paid twice as much, they raise the wage to twice as much as it might be, the cost of your food may only raise $1 or $2, or the price of your item may only raise $1 or $2 because they're spreading out that cost among multiple items being purchased. So that's how companies make money. Once companies have their money, there are lots of things that they do in order to make sure that money can't be traced and or to make sure that money can't be taxed. So one, of course, is to offshore the money. Google and Apple have their headquarters in Ireland. This is to avoid U.S. corporate taxes. Another way that companies hide their money is in charities. So you've probably noticed that every billionaire and every very rich company has a foundation of some kind that does charitable work. Well, so what happens is the corporation gives lots of money to the charity, and the charity probably is doing charitable work. So I don't want to discount that, but I've talked enough about how charity is not sustainable today that hopefully I don't have to redress it. But if you are interested in that, go to my video on COVAX vaccines. COVAX and vaccines, change, not charity, and I'll talk a little bit why charity is really not sustainable. But anyway, so they have these charities, and what ends up happening is, like any individual, a corporation can write off their charitable contributions as tax deductible, right? And of course, if you give enough money to these charities, your taxes are so low that sometimes the government pays you, right? So this is another way that corporations keep their money, or at least avoid taxes. Yeah, so those are the two major ways. There are some other ways that companies hide their money, like having lots of little shell corporations where money flows through little bits at a time, small enough to only pay little bits of tax on them. And there's lots of complex schemes there, but we really don't have enough time to talk about them today. Maybe I'll pick up on another day. But for now, so how do we tax corporations? How do we get over these hurdles that corporations are putting in front of government in order to stop them from collecting taxes? So like my comment with taxing the rich, you can implement a leavers tax. Anytime corporate money or a corporate job leaves a country, there can be a tax on that. If one way to do this is a tariff, which is to say that you make it unsustainable for a product you made overseas. So essentially what happens is if a product used to be made in country A and then is shipped to country B to be made there and then shipped back to country A can pass a law saying that any good coming from country B is going to be taxed at such a high rate that essentially the price of it to consumers in country A becomes prohibitive. So they buy some other product that is made in country A, and then, of course, the hope is that the company will bring their manufacturing back to country A to avoid the tax, right? So this is a leavers tax or a tariff, and they work in slightly different ways, but it's more or less the same idea. You're punishing money for leaving the country. Another way you can do this is you can implement higher taxes on companies that are not based in your country. This would be like a headquarters tax deduction or something like that. You could make the corporate taxes much higher and then say, hey, if you incorporate in our country, or if you have a principal place of business in our country and you're making goods here, we'll waive a tax or we'll reduce the tax for you as well. Another thing, of course, is to tax a company based on how many shell companies they have. Now, this is going to be difficult to do, partially because lots of these shell companies are opaque, but there are often reporting requirements for companies, so you actually do get to see how how complex these corporate structures are, and you can count the amount of shell companies they have and holding companies and what have you, and you can tax those as is. Again, this is a role for bureaucrats who are able to look at the numbers and decide what will be cost prohibitive for these corporations and whatnot. But essentially, at the end of the day, these are some ways that we can use as workers in our advocacy for more worker power and more economic democracy, and in taxing the rich, in taxing corporations, to make sure that we are making sure that they pay their fair share, and so that the tax burden on us, on regular people, is reduced as well.